Are you fed up with filing taxes and wonder how the riches are managing it all? If yes, then we would like to tell you that most of the riches have a secret. They actually know ways to not pay the taxes. Yes, you heard it right. In today's video, we are going to enlist certain ways practicing which, like riches, you can also save yourself from the hectic job of paying taxes. Stay with us till the end of the video because some of these options will amaze you. But before we begin with video, please take a moment to subscribe to the Bling Finance and don't forget to hit the bell icon so you get notified when we come back with another amazing video. So let's get started. 1. Charitable donations. Giving money to nonprofits has long been a way for the wealthy to get a tax deduction. And under the new tax law, the amount you can deduct has increased to 60% of your adjusted gross income from 50%. 2. Gifting. One way to get around property taxes is to pass on some of your property to family members through donations. In 2022, you can exempt anyone from taxes up to $16,000. During your lifetime, you can give up to $12.06 million of your assets as a gift before gift tax is imposed. There is no limit to the number of people you can offer in a year. So if you own $18 million in real estate, you can gradually transfer your assets to your loved ones until the net worth of the estate is less than $12.06 million. Remember that this threshold applies to both gift tax and inheritance tax. 3. Tuition fees. This tax savings benefit is only available to individual parents or guardians with up to 2 children per person. As an example, in India, tax deduction up to 150,000 rupees can be claimed as school fees paid for your child's education. Moreover, this deduction is independent of the class of the child. However, the course the child is enrolled in must be full-time at a school, college, or university in India. Certain countries have tax-saving benefits for self-education as well. 4. Life insurance trust. If you don't want your family members to experience financial hardship after your death, you should purchase life insurance. Life insurance proceeds are generally not taxable, but after your death, they can become part of your estate and are taxable. To avoid being taxed on your life insurance proceeds, you can create an irrevocable life insurance trust. You are essentially creating a trust and transferring ownership of that fund to someone else. The trust is irrevocable because in the future you cannot adjust it without the consent of the beneficiaries of the trust. By surrendering your life insurance policy, your death benefit will not become part of your estate. However, it is best to do this as soon as possible. If you die within 3 years of the assignment, your life insurance proceeds are still considered part of your taxable estate. We have all come across the saying, instead of working for their money, the rich can make the money work for them. 5. Estate. You would have noticed that most rich people own more than one estate. That happens because they invest in property to create an asset for themselves instead of paying taxes. Moreover, even if you register a property in your name under certain limits, you will save yourself from paying taxes in all cases. So it's a win-win. 6. Investing money. Several tax breaks exist to encourage investment in things like movies and small businesses, and the wealthy can use them to lower their tax bills. Programs that provide initial tax relief on your investment. With the Enterprise Investment Scheme, you get 30% off your investment, up to a maximum of £150,000 PS per year. As long as it's profitable, the plan will pay an annual dividend, which may be taxable if you earn enough elsewhere. Some investors have created them employment in order to borrow money to invest in the EIS and use the dividends to repay this loan. 7. Present a loss on paper. Many losses can be deducted from income or capital gains to reduce your tax bill. Any good accountant will help their clients minimize their tax bills by finding legitimate losses they can use that way. but some more aggressive tax avoidance schemes seek to create artificial losses. 8. Leaving town. This is not as easy as it used to be, as you'll need to be overseas for at least 5 years before you can escape tax on capital gains held in the UK. If you work a full tax year outside the UK, you will no longer be subject to most UK tax, but will be taxed on some UK income. 9. Putting money offshore. There are investment programs that allow you to keep your money in an offshore fund and increase the interest you earn from it. You will pay tax on withdrawals, but until then you can withdraw 5% per year tax-free. You can choose when to make your investment, so you can plan for reductions when you're a basic taxpayer instead of a high-rate taxpayer. 10. Offset possible alternative minimum taxes for this year and next. If you are subject to the alternative minimum tax, AMT, making additional charitable gifts claimed as itemized deductions could reduce the difference between regular income tax and AMT. This is particularly useful because many commonly itemized deductions are added back to income under the AMT, including state and local income taxes, real estate taxes, home mortgage interest. So these are 10 ways rich people avoid paying taxes, and so can you. Which of these points make sense to you? Let us know in the comment section below. If you enjoyed watching the video, don't forget to like, subscribe, and share the video.